Hi, everybody. This is Donnie Winchell again. This is another video in our series encouraging people to think carefully about getting into the wine business and to provide some guidance. As with all of the other videos, this is not to be regarded as financial advice or as legal advice. These videos are just a compilation of 30 or more years of experience in working with wineries across Ohio and across the Midwest. This is a dream. The dream requires some reality checks, and hopefully this financing piece will be a part of what you'll consider before you get into the wine business, so that when you do open this dream winery, it will be successful for you and your family and potentially for generations to come. A long time ago, an accountant told me, when we were looking at some business opportunities, to understand that cash is king. It's important that if you have the resources, if you have a sugar daddy, if you have a big inheritance, that you look at the cash that you have available and put that towards your business. But in most cases, nearly every winery with whom we have worked has had to borrow some money to launch their dream. So when you're looking at this from a business perspective, not from an emotional perspective, you need to understand that there are 5 C's that you need to consider in preparation for looking for that money to begin the winery operation. First of all, you have to look at the economic conditions around you. We'll talk about that a little bit later. But in a high interest situation, it's much more difficult not only to get loans, but to pay them back when, in comparison to the days when money was cheap, 1 or 2 or 3%. So look at the world around you and assess what the circumstances are with the general economy before you move too far forward. Secondly, you need to think about character. Character is who you are. This is your personality, your strength, the opportunities that you bring to the business so that it will become successful. You have to have some collateral. The bank or a lending institution is not going to loan you money just on your good looks or on your great personality. You'll have to have some resources to put behind the opportunity to make that loan. Then you have to think about capacity. You have to identify the capacity that your business will have to return and a profit for you, but also to pay back those loans that the bank is going to ask and need to have made on a timely and regular basis. And then you're going to have to think about some capital. What kinds of cash do you have to bring on board? How can you look at the resources that you have, generate enough down payment in order to make this thing successful for you and to mitigate the risk that the lender is going to deal with? First, we'll talk about character. You may be a handsome fellow or a good-looking woman, and you may have had some significant challenges in the past with businesses you've run, either businesses or personal. If you have those challenges, address them, understand them, and identify for the lender how you overcome those challenges. Have you been in business before? Is this your first time at a entrepreneurial experience? If you've been in business before, how long have you been in business? What kinds of strengths did those years in business bring? And communicate that with your lender. How long were you in there? And what kind of career did you have? Is it germane at all to the circumstances of a winemaking and wine sales in an environment that exists? If you have some marketing skills, that will be good. If you have accounting skills, that will be good. But you need to understand what skills you bring from a former life, from a former experience to the table that will make the lender more comfortable with providing resources for you. And look at your credit score. If it's under 700, take a deep breath, take a break, build that thing up, and make sure that your 700, 800 credit score is in place for a good long time before you move too far forward. And then, if you have some affiliation with the existing wine industry, what's your reputation there? Are you a grower? Do you grow good quality fruit? Have you worked in a wine cellar and you have experience with making wine? What is your reputation and how does the industry regard you? The testimonial of some of your peers will likely help you when you're looking for that loan. Then capital. You've got to have cash. You need a down payment. Um, Sometimes they're looking for 10, 15, 20, 30% cash. It is not always easy to come up with that, but it is going to make your life in terms of seeking out funding much smoother, much easier. And then take a look at the assets. What do you own? Do you have a small business? Do you have a car? Do you have a home that you're willing to put up? What is your net worth? And then what kind of liabilities do you have? Do you have a big mortgage on that house? Do you have a bunch of student loans you still have to pay back? So what you need to do is identify what your net worth is, and that is what the bank regards as your capital. Subtract all of your liabilities from the assets that exist and come up with some kind of a number. That is going to be a part of the balance sheet once the loan closes. That will be part of your financial documentation. And then you need to think about the capacity of the business itself. What is your projected level of gross and net income? Remember, gross is different than net. If you've been in the business for a little while, how successful has the business been? If you're looking for an expansion, that will be an important document to share. If you're brand new to this thing, make sure that the numbers you provide to the bank in your business plan are realistic. You need to understand that if you sell 200,000 bottles of wine at $20 a piece, you've got $400,000 of gross income, but that surely is not your net. You need to subtract all of your expenses. And you need to figure out what your total payments will be after closing. Will you have to find some additional sources of income? Well, one of you have, or two of you, your partners both have to work full or part-time to keep things moving at the beginning. And I don't know of very many businesses of any kind whereby the owners were able to take out a salary for the first year or two or three. If you can find an outside source of revenue with a second job, with someone as one of your partners who will be working and not pull any money out of the business for the first 4 or 5 years, you'll be well on your way to a much more level of success than other folks who have to begin taking grocery money out of the cash flow from the business. And when you put those numbers together, make sure they're realistic. I remember when Larry and I first got involved in this go-kart business that we own, I was so unrealistic when it came to the revenue streams. The bank just laughed at me. They said, go home and figure this out and be more realistic. You need to make sure that what you are projecting can and likely will be achieved. And if anything, underestimate so that you can surprise them with the relative growth and success that they really didn't anticipate. You're going to have all this written down. There is a video that we offer about developing a business plan. You need to have a robust, multi-page, detailed explanation of how you got to those numbers that you supplied in that business plan. Now there's something called collateral. If you cannot make your payments, if cash flow is slow, if you have a disaster that you don't anticipate, the bank is going to require that you have some sort of way to repay that loan if your earnings fall short on a consistent basis. Typically, if you're going to build a building and open a winery, you will need at least a 10-year loan, most at least 10, sometimes 20, sometimes 30. But if loans are 10 years or longer, typically the bank or the lending institution will require that be collateralized with a mortgage on real estate. A very, very sad story. A number of years ago, there were two wonderful families from the Sandusky area. The gentleman worked for years at the Ford plant. They took an early buyout. They had a giant chunk of change, in their view, a giant chunk of change, and opened a winery. They really did not know what they were doing. They had no business experience. They overspent. They based their decisions on gross income, not on net income. And within about 5 years, the beautiful homes that each of them had owned right on the shores of Lake Erie were sold. The bank repossessed them. They lost them and they ended up losing the business, losing their homes, and living in a trailer park someplace in another part of Ohio. So make sure that when you are putting this collateral up, that you understand that you are putting a lot of things at risk. You need to understand the loan needs to be balanced with what the bank needs or collateral and what risk you are willing to take. I talked a little bit about the conditions at the very beginning of this video. You need to look at those conditions. What is the general economy like? Several years ago, interest rates were very low. Not so much in the mid 2023, 24, 25. Interest rates are very high. Looking at your monthly mortgage payments with a 1%, a 2%, a 3% mortgage, very different game than looking at the mortgage payments that you'll have to make with a 6 or 7 or 8 or 10% mortgage rate. And understand that very often commercial rates are significantly 2 or 3 or 4 points higher than the kinds of rates you would get on a residence, because the bank is looking at risk and whether or not your credit is worthy of a lower interest rate. So again, back to that credit rating. The closer you can get to 800, the better off you're going to be in a credit rating. Lenders are very risk adverse. They are very concerned. They sometimes will approve riskier deals. We'll talk a little bit about risk in a minute, but they may require that you put up life insurance. They may have somebody require that they co-sign. And remember that the co-signer is as much on the line for paying back that bill as you would be. So you need to make sure that that person has the capability and the credit rating and the resources, because the bank is going to look at them too, so that the bank can be assured they get their money back. They'll look for extra collateral. If you have some contracts where you have some relationships already with some folks that indicate that maybe you'll be able to sell some of your wine, maybe you're doing some bulk wine and you're selling to a smaller winery, all of those contracts and documentation will help a little. But most important, make sure that your projections are accurate. Make sure that you understand the budget and the things you can spend on, so you're not spending wildly, and put all of those in that business plan that is so very important when a bank begins to talk to you. Minimum standards for most lenders. We talked to a bunch of lenders in getting this video prepared, and they require, almost without exception, at least 700. If you are under 700, take a break, as I said before, get that credit score up and hold it there for a while. They also are going to require capital of sometimes as much as 40 to 50% of your net worth as a percentage of your assets. In other words, you may have to put up your house. Maybe your house is worth $300,000. 150,000 of that is going to be put up. As long as you have that kind of equity in your house, you'll have to give up all of that equity, maybe as a part of your capital. And also understanding your business plan and your pricing and what for price point at which you're going to sell your wines and what else you're going to do to bring more revenue in besides wines, is at least a 1.20 debt coverage ratio. You have to be able to cover the debt and make a little money to cover your expenses before the bank is going to loan you too much. And the collateral has to be 1.5 times the value of the loan. So you're putting a lot on the line to make this happen. So your conditions depend on all of the circumstances that we just outlined in this little slide. So then you have to look at yourself. What do you do well? If you're a fabulous entrepreneur and you're a rock star, you are going to be probably great at what you do, but you can't do everything. So early on, identify an accountant if you are not good in accounting. Identify a lawyer if you don't have a degree yourself. Identify someone to help you market, because the greatest wine in the world will never be sold unless someone knows about it. There was a very, very famous man called Leon Adams. He's known as the father of California wine to many. And he says all the time, the best wine in the world will never be sold if the world doesn't know about it. So understand that accounting, legal advice, and good marketing programs are just as important as that great wine. It's not a situation of, I will build it and they will come. The situation is, I will build it and tell them about it in a professional, well thought out way so that they will come down the road. But you have to tell your story. So then you need to figure out what you're going to need money for beyond what you already have. So you're going to have meet a payroll. Labor is expensive. You may have to pay rent or mortgage for sure. You're going to have some maintenance. A press will break down and you're going to need a new pump, and the tanks aren't enough for a big harvest. So you're going to need to think about things that you're going to need for additional cash flow. Sometimes we deal with regulatory changes. Wine America is and your state of trade association are huge proponents of protecting you. But sometimes wine taxes do go up when the government is looking for more money. So that you need to put all of that into your calculations. And there may be a crisis. Our friends in California with those terrible wildfires, or sometimes there's a flood someplace in the Midwest. You need to think about the fact that you may need some money if there is a crisis. So, with those considerations in mind, do you need to acquire a short-term line of credit? And I underscore short-term. Line of credit is not for daily operations. Do you need permanently capital? Lots of times, the big farmers, the big soybean guys, borrow a whole bunch of money in the spring, plant, and then pay off their loans in the fall. Will that be the kind of circumstances that you're going to need for a while? Are you going to have to buy fruit at the beginning if you're not growing your own? And so are you going to need money, capital money? You need to buy those bottles in advance. You need to figure out how you're going to pay that off in addition to paying off your loan. If you have an existing operation and you're expanding, or you plan to expand down the road, will you find a need for more resources for capital expansion? One of the earlier videos we talked about when you build your building, always build your building with the expectation you have to expand. It's sort of like when you move into a new house and there's all this cupboard space and you're thinking, oh my goodness, how am I going to ever fill all of this? 6 months later, you're looking for more space for those dishes or that air fryer that you just got as a Christmas gift. Also, how seasonal will your business be? If you are in Texas, when it's really hot, you may not be as busy in the summer. If you're in Ohio, when it's really cold, you will not be as busy in January and February. So look at your seasonal cash flow and see if you can negotiate with your bank the opportunity for during what you project will be the slow months to pay interest only. Recognizing that by not paying down the principal, you'll be extending the payments over years, but it will prevent you from having to come up with $14,000 in loan payments in February when no one is walking through the door because there's just been a blizzard. So think about working with your lender to make sure that you consider those seasonal cash flow issues, and they understand those too. You're probably going to need long-term financing for capital projects, building the building and maybe major expansions. And again, those generally will be 10-year, and you'll need to have some collateral for that. And if you're going to find a need for permanent working capital, the second item on this list, make sure that you're using it for permanent needs. Make sure you are not using your line of credit for permanent working capital. That should only be for a short term only. If you're gonna have to buy 2 new tanks because you have too much juice coming in, that's maybe why you use a line of credit. It's not to make payroll for sure. We talked to a bunch of lenders again, and the number one thing they shared with us is how much they hate risk. They hate risk not because they don't want to loan it to people. They hate risk because they have to answer to their underwriters for bad loans. If a bad loan is made, the lender will typically need to make 10 to 15 good loans just to break even. So they're very risk adverse. A simple analogy I'll give to you is in your gift shop, you may be selling sweatshirts. You sell the sweatshirts for $30 each. 2 of your employees walk off with sweatshirts and not paying for them. That $60 will require that you sell at least a dozen more sweatshirts just to break even. On a much larger scale with much larger numbers involved, that's why a banker, a lender, will not easily offer a loan that they don't regard as one that they can recoup their investment in. Now, if you're going to find yourself in a quandary in some cases, and that may come up, be ready to communicate with your lender. Let them know what is going on. Do not wait until you have 2 or 3 late payments to say something to your lender. If you have some good references, that will help you at the beginning, and maybe it will. Maybe you'll have to add some collateral. But if you have good explanations, and more than that, a plan to address the shortfalls, to offset any setbacks, the lender will be much more willing to loan you money at the beginning. So think through in your business plan what might go wrong, and then identify some ways to provide a fix should those negative circumstances occur. Okay, so you have some money on your own, you put the money in, you've got some collateral, the bank is giving you some money. Let's say you need $100,000, but at this point, between what the bank will loan you and what you have to put cash in yourself, you're about $15,000 or $20,000 short. There are some ways to identify some gap funding. Gap funding is what happens when you're short at the bank when you add your personal investment into it. So the advantage of gap funding is that it spreads risk out for everybody. I will tell you, though, that there are some pecking orders within the risk factors. There will be, if you're finding an SBA loan, they may need to get paid off before your bank. And if there is a shortfall, certainly your money will be the last to come out of the business. So you might not need as much collateral, but you will be third or fourth in line in terms of payback should there be a shortfall. So go to your local SBA offices, go to your Chamber of Commerce and find out the sources. Go to your Joint Economic Development District. Go to your Port Authority and see what kinds of money might be out there for you to loan via SBA. I am a huge fan of Farm Credit. Farm Credit, if you don't qualify or if you need money, Farm Credit is a huge opportunity. They understand farmers. They have lots of low interest opportunities that I'll address in a couple of minutes. So go visit your county farm credit office in the county. Make sure that you talk to them, maybe even as you're talking to the bank. We have a number of wineries with whom I'm familiar that have used farm credit for all of their lending, and some have used it for the gap opportunities. And finally, once you have most everything together and you have that shortfall, sometimes you need to do some homework. There may be a county economic development council. Your city may have a revolving loan fund. This is a situation where the public entity puts up a chunk of money and then loans money out in smaller increments to businesses that will enhance the tax base and the quality of life in their community. What happens is you'll take the loan out from this revolving loan fund, and then you'll begin paying it back. As you pay it back, the revolving loan fund will then loan some additional resources to another business. Look and see if those are some opportunities for you for gap funding. Additional hints. Again, I reiterate how much lenders hate risk. So make sure that you are ready to address all of those potential shortfalls. I would also encourage you to go to your local USDA office. There are wonderful programs that USDA offers. A lot of paperwork very often, but minority and female-owned businesses have lots of opportunities for lower interest loans. First-time farmer loans for young people are very, very good. They have micro loans. Maybe you only need $5,000, and a micro loan will get you that press that you couldn't afford with the money that the bank had given you. Sometimes they have emergency loans if there's a disaster, and sometimes they offer down payment loans. There's all kinds of options. I would surely go to your FSA office in your county. They can direct you to the USDA programs that are out there. And then finally, I guess even before you go too far down the road of finding funding with a local bank, you probably should chat with some of the wineries in your area. Sometimes the banks are a little skittish about loaning money to something like a winery that they don't understand. It's better than it used to be, but even so, there is some concern about whether or not these things work. Back in the early 2000s, breweries popped up like flowers in a field, but many of those failed. And so the current brew business is much more solvent, filled with many more savvy business people. But the lack of understanding of business of some of those early craft brewers makes some local banks skittish about loaning to alcohol. So if your neighboring wineries, if your area wineries have good experience with local banks, and the banks have gotten their money back from those wineries, you may want to chat with the wineries to see who you might want to talk to about looking for the money that you need. Finally, some cautionary tales. For goodness sakes, for goodness sakes, for goodness sakes, look at the danger that come with variable loans. In an inflationary environment where the variable expires after 3 years and you go from 2% to 9% interest, it's going to take a deep cut into your business and put potentially some of your business in peril. Again, look at the payment options. Maybe you can pay monthly, maybe you can pay quarterly, maybe pay annually, but however, you may want to pay seasonally, and maybe for that seasonal 2 or 3 months in January, February, March, you are only paying interest. Again, remembering that it will extend the obligation to a number of years. Also, understand the difference between construction loans and operating loans. Construction loans are used to build your building. Generally, there's a fund made available, and your builder or you have draws periodically as you go. You are only paying interest on the money that you actually take out. So if you don't take out all of the construction loan, then you're not paying a big chunk of interest all the way through from construction until cash begins to flow as the business opens. So look at the difference between a construction loan, and then once you're open, you'll convert to an operating loan, again, based on the advice from your vendor. And if you can get some of your vendors to pre-authorize the fact that they're going to buy your wine, or maybe you're going to be producing a lot of grape juice and some of the smaller wineries in your area will be buying juice from you. If you have some pre-authorization of those contracts, share those with your vendors. They do help. One of the most important things, however, and I put this at the end because people don't think about it till the end, but I want you to slide this concept to the very beginning of your strategy discussions with your partners as you build this business. At some point, you're going to get out. Are you hoping to have a very successful operation and sell it so you make a bunch of money on it? Not so easy. A small business sometimes takes 3 or 4 or 5 years to sell, even with the best of record keeping. However, do you want to do this the rest of your life, and are your kids interested? But if your kids are interested, what's your succession plan? Dave Marison does an amazing job on succession planning and family dysfunctionality. If you have 3 kids and one is involved with the business and the other are not, make sure that whatever decisions are made are on paper so that you do this at the front end so that there'll still be happy holiday celebrations when the business moves on to the next generation. You make the decisions in the front end and put them into your business plan and on paper and have everybody understand all the parameters to that. It doesn't take long for 20 years to go by. In a successful business, it will create issues, and in an unsuccessful business, it will create issues. So make sure this exit strategy is in place and on paper and shared with the people that need to know about it. The other thing, and this is the last slide, I think, make sure your business is saleable, either selling to the next generation or allowing them to inherit it. But most importantly, if you decide you want to sell it and cash in, my son works for the local Port Authority, and he says, Mom, I see it all the time. When it is a long walk from the cash register to the bank, people have a very hard time selling it because only when you go to sell this can you show the potential purchaser what the business is worth and what is in your books. And lenders will only lend as you want to expand on what is in your books. So if you're doing too much 5-finger discount and putting it in your pocket, you need to make sure that you are putting things in the book. Under the table collection of resources, collection of profits is not good for anyone. And even if you're planning on turning it over to one of the kids, if they need to buy it from you, if they're not going to inherit it right out, is there going to be enough equity, showing on the books again, for them to borrow against the business to purchase one or to expand if they need to do that? So make sure that your record keeping is accurate and you're being authentic and honest in what you're doing. This dream of creating a winery can be an amazing exclamation point to an amazing life. It can be a nightmare. So make sure when you transform this dream, you understand what the finances of owning and operating a winery are all about. Thanks very much.